Chapter 21, the Income Capitalization Approach. In appraisal, we analyze the amount of money a person would pay today for the anticipated income each year in the future plus the reversion. All right, what does that mean? In other words, the present value of the property is the future benefits, those cash flows, plus the resale or the reversion at the end of that holding period. What principles apply? Anticipation and change in supply and demand. So anticipation and change, basically, what's the value going to be equal to now based on what may happen in the future? What changes may occur, whether it be revenue, whether it be market conditions, what may happen in the future? And how are we going to discount that back to present value to come up with our conclusion today? In direct capitalization, we would just take that 1 year NOI and capitalize it. Supply and demand, it's reflected in the income rates. So if there's an oversupply, rates are going to fall, values are going to decrease, and vice versa if there is an undersupply. I'm going to go through the different types of leases and expenses and some definitions here. Many of these definitions are in your textbook. I'm going to add a little bit to what's there. When we're talking about types of leases, we have flat leases, variable rate leases, leases with annual increases, and then percentage rate leases or percentage lease clauses. Flat lease, pretty straightforward, no rent escalations. Generally, flat leases will run an extended period of time so that you're still, the investor or buyer or landlord is still getting that revenue for an extended period of time. Shorter lease terms might have percentage increases. So variable rate increases, they might go up 50 cents in 1 year, $1 the next year, $1.50, et cetera, depending upon how that lease is structured. Leases with annual increases, set amounts, 3% per year, dollar amounts, increases that are set within that lease. Percentage lease clauses or percentage leases, basically the landlord's going to receive a percentage of the sales volumes, generally retail, and sometimes those break points are so high that they never really get that percentage rent. And other times, what a landlord will do to try to get a particular retailer to come into a shopping center, for instance, is set that rent a little bit lower in anticipation of maybe generating additional business over time and collecting more percentage rent in the future. Expenses in leases. Gross lease is also called a full service lease where all the expenses are paid by the landlord. Triple net lease, all expenses except management and administrative, plus reserves, but reserves are generally excluded, at least in most markets. But the most important thing you need to do when you're talking about leases is verify what a triple net lease means, or a double net lease means, or a net lease. It means different things to different market participants. So it's important to understand what expenses are being paid by who, and whether reserves are excluded. Absolute net lease, all expenses are paid by the tenant, including reserves. Absolute net leases might be for a drugstore. Walgreens, for instance, may have an absolute net lease, or maybe fast food restaurants. Different types of rent: market rent, amount determined by the market; contract rent, that's what's in the lease; effective rent, if you have concessions, which we'll go through in just a minute, that is what you're actually receiving, the effective rent that you're receiving. Excess rent, the amount that exceeds the market rent, and we have to think about whether that's risky. It depends upon the market, depends upon what's happening within the market, and that's your subject property. Deficit rent, below market, again, is that risky? You have to look into it. Percentage rent tied to the level of sales, overage rent, amount paid for a percentage over the base rent. So we've talked about how we calculate our NOI. I'll go through it real briefly with you. We have our PGI, our effective gross income, which is less vacancy and credit loss, again established by either the property or the market. We come up with our NOI, which is EGI, less our fixed and variable expenses. Examples being fixed or real estate taxes, insurance. Variable expenses would be administrative, repairs and maintenance, utilities, payroll, might be a management fee. So those are examples of variable expenses. Variable meaning that they're going to vary over time. And our reserve amounts would be capital improvements, things like roof repair. It would be things like parking lot repair or HVAC replacement. Here's a reconstructed operating expense. We've talked about that a little bit, how we have to normalize our operating statement and take out the expenses that would not apply, that may be in that operating statement and not something that a typical buyer, seller, or other market participant would have in there. So here's the reconstructed operating expense. We've come up with our PGI. You can see the vacancy, our property and insurance, property taxes and insurances are our fixed expenses, and then we have our repairs. In this particular example, they are deducting reserves and coming up with an NOI of $289,200. The key here is to understand that if reserves are included in the operating statement, and if they're included when buyers and sellers are analyzing different investments, it will impact the overall capitalization rate, the derived overall capitalization rate by sales. So you have to be consistent if you're going to include reserves, or if the market includes reserves when they're looking to establish an NOI, then we have to include it in the comparable sales and how we calculate the value of a particular property. So debt service not included in our operating expense reconstructed statement. Here are the examples of fixed and variable expenses. Obviously, one varies with occupancy, the other does not. And then our replacement allowance. Again, here's where I just mentioned whether or not cap rates of comparable properties are included or not. Under rates of return, we have our internal rate of return, our overall yield rate, equity yield rate, and overall rate. A little repetitive, but I'll go through a little bit. Internal rate of return is on that capital investment, considering the price paid for the investment, the cash flows, and the reversion. Overall yield rate is that rate of return including debt and equity. Equity yield rate of return on the amount paid as a down payment from that periodic income after debt service and including the reversion after the debt's paid off. Overall rate, relationship of 1 year's NOI to value. Here is an exhibit of 3 sales where, in our subject, where we're showing the operating expenses, our revenue, what our NOI would be based on the information that we have, and what our extracted capitalization rate is for these sales. So pretty straightforward here that the cap rate's going to be 9%, and with our NOI of $273,925, we're dividing by that cap rate of 9%, coming up with a value of $3,043,611. Probably wouldn't include the pennies here, and I would round it maybe to $3 million, depending upon how you're rounding with that throughout the report. Rounding's important. If you're not consistent in your rounding, then the value conclusions in all of the approaches can't really be reconciled. Here's a cash flow projection showing you have 6 tenants, they're generating revenue, some are flat for a while, some are increasing each year. You have your potential gross income for all your years. This is a 5-year holding period, so the 6th year is just for the reversion. We have our expenses, we have our reversionary cap rate, also called terminal cap rate of 10%, and that's applied to the last year NOI of $218,002. That's where we come up with our reversion of $2,180,020. So that's added to those cash flows. We discount it back to present value, come up with a value of $2,000,002 rounded. When we're estimating rates, certainly in fact, inflation's a factor. The change in buying power of the currency, that may affect the investment. And unfortunately, almost all competing investments suffer under the same inflation rate. Therefore, that competition will not allow the investor to adjust this factor. And investors may want higher yields during high inflation periods, especially if there aren't alternatives out there. Here's just our formula, again, covering up the what you're trying to determine. And so if you're trying to determine rate, it's income divided by value. And if you're trying to determine income, rate times value, etc.